So let's review a couple of other potential scenarios. If the capital that you are investing to generate the income is considered to be very, very long-term capital, what we would call intergenerational capital, we would more than likely want to take out even less than 4%. And we would take out something in the range of around about 3% to provide every opportunity for your principal to remain growing into the future, regardless of the economic environment. This lower income strategy is critical if you wish to ensure that a large pool of capital remains relevant and an engine of growth from one generation to the next generation. An example, if you were to inherit, let's say, $10 million, and you wish to ensure the next generation benefits to the exact same degree that you will from this capital base, then by taking out $300,000 a year, or just 3%, in most environments, this will likely ensure that this 10 million has the same relative benefit to your children as it did to you. Perhaps it's worth 20 million by the time it's passed on to the next generation. Now, conversely, of course, you can take out any amount you want from your portfolio as an income, but that's going to have consequences if that number's high. The more you take out of your portfolio as an income, the less opportunity that portfolio has to grow to keep pace with inflation. If indeed you begin to withdraw 8 or 9 or 10 or 12% every year, or any number above that, the value of your portfolio will not only not grow on a relative basis, it's more than likely going to shrink. This would be a problem in most cases, but in some cases, perhaps in a situation in which an investor does not need that income indefinitely or for a long period of time, or perhaps in a situation where they do not need the principal to exist for a long period of time, then the decrease in value of the principal portfolio is less of an importance than the need for the income this year or next year. This would usually arise in stopgap situations. So just remember that returns are never guaranteed, and the more that you take out, the more you put your capital base at risk if the market corrects downwards. Currently, with inflation running at 8 to 10%, how do you account for this when planning for your income? This now is the exact problem that many people are facing in our heavily distorted economy at present. Thank you for watching, folks. We at McIver Capital Management are always looking out for your best interest. Please don't forget to subscribe, leave a comment, tell me what you think. It's important. Let's have that conversation.